Hey guys, and welcome back to the Finance Now podcast. This podcast is purely for informational and educational purposes, and it's my way of sharing my knowledge, research, and opinions with you. I'm Anurag Birla, and this week has been a big week, both in terms of the macro picture as well as earnings and microeconomics. So jumping right into it, let's start out with the macro data that came out, right? There was a bunch that came out this week, starting off with JOLTS. So this is the Job Openings and Labor Turnover Survey, which was for the month of March. It came out lower than expected. The market expectation was about 7.5 million versus what actually came out, which was 7.19 million. So, less than expected, which isn't great, maybe causing a bit of anxiety in terms of what the unemployment or employment labor market looks like. But then we couple that with, some of the other information pieces that came out, the Consumer Confidence Board, the CB Consumer Confidence data that came out. Now, this was the lowest in almost 5 years. And as you can expect, it was predominantly due to fears from tariffs, right? The reading fell to 86, which is down 7.9 points from its previous reading, and it was lower than the estimate of 87.7. So this also came in lower than what was expected by the markets, which wasn't great. Now, if we look at GDP for the quarter shrunk, right? It was actually down 0.3%, so negative 0.3% versus what was expected to be a 0.2% gain. So it was expected to be more or less flat, maybe slightly up, but rather it was negative. And when you couple that with the PCE and core PCE, which is essentially the Fed's preferred inflation gauge, PCE was slightly higher than what was expected. So PCE year over year was 2.3%, expectations were 2.2%, but core PCE was pretty much in line with expectations. Year over year, the core PCE reading was 2.6%. Now, as I mentioned previously, I don't think we'll be seeing the effects of tariffs on inflation yet. There was that 90-day pause, and there are still negotiations going on, trade deals to be made, and I truly believe that the rise in prices, the actual material rise in prices, will only really show up in the coming quarters or the rest of the year, for that matter. Other pieces of news that came out were the initial jobless claims. So this is back to the labor market, I guess. We have initial jobless claims, non-farm payrolls, and the unemployment rate. So initial jobless claims, which is weekly data, came in above expectations. It was 241,000 versus what was expected to be 224,000. So perhaps this is something to monitor for the rest of the coming months, see if we can spot a trend. If you couple JOLTS, consumer confidence, GDP, and initial jobless claims, it doesn't paint a very pretty picture of the economy. But then you look at non-farm payrolls and unemployment. Non-farm payrolls were higher than expected, which is surprising, significantly higher as well. It was 177,000 versus what was expected to be 138,000, and unemployment was right in line with expectations, 4.2%. So when you look at unemployment and non-farm payrolls, this is positive news for the labor market, on this front. It shows some strength in the economy, but obviously looking at consumer confidence, looking at JOLTS, looking at GDP, you do tend to worry about growth in the economy. And if inflation starts to pick up, if PCE starts to rise and we see that GDP number not really change, that stagflation worry becomes more real, right? But I will say, from all this macroeconomic data, I think, this just reinforces my belief that the economy is not actually suffering as much as people are expecting it to, right? And that's on a current basis. I can't speak to what's going to happen in the future, but it reinforces my belief that rate cuts right now are not needed. These premature rate cuts are not needed. And I think we all know that Trump is really pushing for these rate cuts to appease the equity markets and to appease the companies, and so that the cost of debt is just lower. But I think looking at this data, right? Sure, growth has suffered in the first quarter, but the labor market more or less seems to be holding up at the moment, and we don't want to be too early in cutting rates, right? Especially when, there is this fear of inflation from tariffs. Now, that's pretty much the macroeconomic data coverage that was there this week. Not much else was said in terms of the tariffs and trade negotiations. Of course, you have these ongoing discussions, but until anything is concrete or solidified, it's not really worth breaking down or talking about. So I want to move on to earnings, right? And initially what I wanted to do was split earnings into two components. Obviously we had big tech, a good amount of big tech report this week, but then I also wanted to talk about F&B, like, companies like Starbucks or Yum Brands, but I'm not sure how much time we'll have, so I'll probably just stick to big tech. But the reason I wanted to initially talk about F&B is because I think it's important to have some sort of outlook or a thought process on consumer behavior going forward. And F&B tends to be a decent gauge, right? You look at Starbucks, you look at Yum Brands, you see they operate in different ends of the luxury spectrum, right? Or different areas of that luxury spectrum, and you can start to formulate an opinion based on the guidance that leaders within the space are giving. But I'm going to stick with big tech because I think they have really been the drivers of the market over the last couple years, and they've been the drivers of the seemingly bear market. I wouldn't actually call it a bear market, but they've been the real holdbacks this year as well. So I think it's important to look at their earnings, what they had to say about capex and what they had to say about tariffs as well. So let's start with Microsoft. Microsoft reported their earnings was pretty impressive. I mean, they reported better than expected earnings, predominantly driven by its cloud business, Azure. Earnings per share came in above expectation at $3.46 versus the expected $3.22, climbing 18% year over year, which is solid growth. Revenue came in at $70.07 billion versus what was expected to be $68.42 billion, a 13% increase year over year. And as I said, this was driven by Azure. Azure grew 33%, which was largely driven by AI. So I think that narrative still holds, that AI bullishness, that AI interest that companies have. And if you look at the entire intelligent cloud unit, which includes Azure for Microsoft, it was up around 21%, producing revenue of $26.75 billion as compared to consensus of $26.16 billion. Now, according to Microsoft, more than 15 million people are now using its GitHub Copilot assistant, which is 4 times more than last year. This is impressive growth, right? Like, the adoption of GitHub Copilot has obviously skyrocketed over the last 365 days, and a 4 times increase is massive in terms of adoption. When you look at the productivity and business segment revenue, this includes their Microsoft Office software, subscriptions, LinkedIn. This segment grew 10% to $29.94 billion, which beat consensus estimates of $29.57 billion. Their more personal computing unit, which includes Windows, advertising devices, and video game consoles, so their Xbox, revenue was up 6% on that front to $13.37 billion versus the consensus estimates of $12.66 billion. Also, talking about this unit of business, this segment, not sure if people are aware, but Microsoft raised the prices of Xbox amid the ongoing policies, the ongoing macroeconomic implications. I think we saw that with Sony and PlayStation as well. So we're already starting to see inflationary effects on some products here and there, right? Like these targeted increases. And I think that trend is only going to continue going forward as these, deals become more hashed out and the tariffs become more solidified. If we look at their more personal computing unit, deeper, we see that sales of devices and of Windows operating licenses increased by 3%, as inventory levels were higher due to tariff uncertainty. So they front-loaded, I know a lot of companies did this, they front-loaded their inventory to avoid some of the tariff costs. And I think a big part of why Microsoft did well post-earnings call as a stock was not just because their earnings report was impressive for Q1, but I think also their guidance was better than expected, which is, in my opinion, what prompted the around about 11% gain in stock price this week. Revenue was guided to be in between 73.15 billion and 74.25 billion versus what was actually expected to be a median of 72.26 billion as consensus estimates. So this is a good beat and raise from Microsoft, right? And I think on a forward-looking basis, they see 34 to 35% growth in Azure as compared to Street Accounts 31.5% consensus. So this is actually slightly higher than what their Azure business grew this last quarter anyway, right? There was no clear indication or sign of CapEx being drastically cut as compared to their initial outlook for the year. Although there was talk of a slowdown in the new fiscal year as compared to fiscal year 2025, right? In the first quarter, what they ended up spending was 16.75 billion. And this is excluding finance leases. So they're well on track to spend a good amount of money on CapEx. And I think this is a trend that we see in terms of capital expenditure that is not necessarily going to change. I still remember earlier this year when the whole DeepSeek thing happened, a lot of people were talking about how big tech doesn't need to spend this much in terms of CapEx. But I think I do remember thinking about this risk of underspending and lagging versus overspending and then at least reaching or staying competitive in terms of what the market expects. So I think big tech have adopted this mentality where the risk of underspending and underinvesting is far greater than the risk of overspending, which is why I think this CapEx is not being cut. But yeah, perhaps the uncertainty with tariffs is just adjusting the timeline of cash flows. But aside from that, there was no clear sign of CapEx being drastically drawn down from Microsoft's end. I think another company within this big tech Magnificent Seven realm or world with impressive results was Meta. Right, Meta earnings per share came in at $6.43 versus what was expected to be $5.28. This was up 35% year over year. That's a huge beat. Revenue came in at 42.31 billion versus what was expected to be 41.40 billion, which was up 16% year over year. And a driver of this was ad revenue. So ad revenue came in higher than expected, came in at 41.39 billion. Versus what was expected to be 40.44 billion. Reality Labs hardware division, the operating loss was actually lower than what was expected, which was good. The sales came in lower than expected too, though, which was not great. So that was down 6% year over year, the sales. But it's good to see that they're getting, I guess, more operationally efficient within that division. The daily active users, or DAUs, was up to 3.43 billion. That is a ridiculous amount. I mean, it's almost half the world. And that was above consensus estimates of 3.39 billion. And if we talk about Threads, their Twitter equivalent app, it now has about 350 million monthly users, which was up from 320 million in January. So adoption is increasing at about a 10% rate. Not too bad. But, moving focus now to AI, right? Meta AI, which is Meta's, I guess, AI platform, now has about 1 billion monthly users. And obviously the way people have accessed Meta AI up until now has primarily been through WhatsApp. But this last week, they launched the standalone app. Now, I haven't played around with it. I haven't downloaded it, although I have used WhatsApp AI multiple times. I think what was interesting about this standalone app was the vision that Meta had, right? The vision that Meta AI is going to be a place to show ads and, perhaps have also a premium version of the app where it could be ad free. So it could be like these Netflix tiers, right? But I think they did mention that the focus currently is on building the product and building the best possible product before trying to monetize, which in my head makes sense. You want to get users used to using your app. You want to get them interested in using your app before you start trying to monetize it with these tiers. Guidance for Meta was in line with analyst consensus. So not much of a reaction, in my opinion, to that, right? The stock was up about 5% post-earnings release. But one thing to note from their earnings was the slightly reduced ad spend from Asia e-commerce exporters. Now, intuitively, this would make sense, right? Given the tariffs, companies in Asia that are exporting to the US are probably less inclined to sell in the US simply because their products are going to have lower demand because they're going to be more expensive. So by nature, this would lower ad spend. So I think this made sense to me, but I think on a forward-looking basis, it would be fair to assume lower ad spend all across the board, simply because of the macroeconomic uncertainty. I mean, there are headwinds. Maybe your domestic manufacturers or sellers are going to increase their ad spend, but if things start to become inflationary and if consumer confidence continues to deteriorate and things become more expensive, I think the amount of ad spend that's going to occur is going to take a hit. And in my opinion, there are headwinds to come. So the company lowered their total expense outlook for 2025, which was interesting, but it raised its 2025 capex to come in the range of 64 to 72 billion, up from 60 to 65 billion previously. So it's not a small raise, but the fact that they're cutting costs elsewhere to increase costs in capex, which is driven by data center investments to support their AI efforts, and an increase, well, part of this raise is driven by an expected increase in costs of infrastructure hardware due to the tariffs. I think it shows how seriously big tech are taking their capex expenditures, specifically when it comes to AI and data centers. So, overall, I think this always begs the question in my head, like, how are NVIDIA going to be affected by this, right? Like, if companies are continuing to build out data centers and invest, how are companies like Intel and AI going to be affected by this? And, it makes me think whether the market are downplaying the stickiness that NVIDIA has right now, especially over these large tech companies that have such big bills to pay in terms of how much expenditure they want to shell out for the year. So for Microsoft and Meta, the outlook seemed unchanged, or in fact, I would say guidance was more positive. Whereas if we look at the next two Mag 7 companies that reported, guidance was not as flowery, and I think that reflected in how the market reacted to their earnings. Apple. Now, earnings for the first quarter under Apple were pretty decent. I mean, they beat the street's expectations. EPS came in at $1.65 versus an estimated $1.63, and revenue was also higher than estimated, came in at $95.4 billion versus an estimated $94.66 billion. Now, if we break down the components there, iPhone revenue was obviously the largest contributor to their overall revenue, coming in at $46.84 billion versus an estimated $45.84 billion. Now, their Mac revenue was also higher than expected, $7.95 billion versus $7.77 billion. iPad, the same, right? What suffered was wearables, home, and accessories revenue. Now, that came in below what was forecasted. It came in at $7.52 billion versus an expected $7.95 billion. Now, this was a little surprising. simply because I know, Apple announced their whole entry into healthcare and like an AI doctor and all these plans, and you would think they would do this based on increased adoption of wearables, but I think maybe the street were accounting for too much of growth, and that just didn't happen. If we look at services, which is something that everyone looks at recently for Apple, it's the second largest driver of revenue. If we look at services, it came in at 26.65 billion versus an expected 26.7 billion. So this is there was strong growth year over year, don't get me wrong, but this came in below expectations. I think this is again the curse of somewhat great expectations from a company that has already gotten many people to adopt their products. And I think their services revenue may be shown a slight indication of slowing down, but I don't think there's anything material there, in my opinion. Gross margin came in at 47.1%, which is exactly what the street expected. And if we take into account tariffs, Apple actually expects gross margins to come in at around 46% midpoint for the year. Now, the impact of tariffs during Q1 were limited, of course, because Apple were able to optimize its supply chain. I remember at one point I can't remember exactly actually how many planes or cargoes that flew back and forth, but they front loaded a lot of their supply chain into the US. And I will say, like, there are plans to obviously shift some of their sourcing, from China, but it's I don't know how feasible it is to kind of pick up and move everything from one place to the other, right? And while Apple's overall results were good, there was some weakness in China, which in my opinion is as expected. If this trade war continues, American companies, it's going to become a question of national pride, right? Like, American companies such as Apple are going to be affected by proxy. And there will be this agenda inside every country where people would be buying or would be encouraged to buy locally developed phones and electronics from Huawei or Xiaomi or any of these Chinese electronic manufacturing companies or these tech companies, right? And I think alongside the China performance, the company did mention an expectation of $900 million to be added to costs simply because of tariffs. Now that's a big chunk of money. That's a big chunk of money. And I think what the markets didn't like is that was the number given in terms of what was expected. But Tim Cook also spoke about the inability to predict anything beyond June, which means the 900 million is only what can be seen, not what's to come. And I understand Tim Cook's perspective, like, it makes sense. It is tough to actually predict what's going to happen because there is so much uncertainty, but I think that's what markets don't like. And I think the fact that there was uncertainty, even in the way Tim Cook spoke about the ability to predict the tariff implications, is what spooked the market. But what I do respect about the way Tim Cook went about his business and the way Apple are handling things is their focus is long term. It's clear. They're not trying to appease to any short term market myopia. They're not trying to, appease to what the hedge fund managers want. They're truly playing the long game here, right? Which is what Apple have been good at as a company, and which is why they've been so successful over such a long period of time. Sure, it's come at a small cost in the short term of the Apple stock falling a bit, losing its status as the world's most valuable company, but those things are honestly just noise. They're secondary. As a shareholder, there are many good signs with the company. The dividend increase of 4% and the intention to continue increasing dividends on an annual basis is something that bodes well with any investor. The buyback clearly indicating confidence in the underlying business. And I think also their ability to maneuver parts of their supply chain. Maybe not pick up and shift everything from China, which is what I spoke about earlier, but Apple shifting some of their sourcing from China to countries like India and Vietnam is important, right? Obviously, the question is how much can they move? But, for the U.S., I think for products that enter the U.S., they can do this to reduce the tariff impact, as much as they can. But the vast majority of products for other countries are still going to be made in China. And I think that's very, very clear from Apple's perspective as well. And I think it's just a good way to I guess take a course of action here. Their supply chain is broad enough for them to be able to do this, and I think they're going to capitalize on any advantage that they may have. Now, moving on to the final company of the big tech earnings, or Magnificent Seven earnings, I shall say, Amazon, right? Now Amazon is probably one of the companies that is most effective by tariffs and the macroeconomic events going on, because over 50% of its product offerings being affected over 50% of its product offerings are actually being affected by the 145% tariffs on China. Results from the first quarter were better than expected, but much like Apple, I think guidance was soft for the current upcoming period. Earnings per share came in smashing it actually at $1.59 versus what was expected to be $1.36. Revenue came in at $155.67 billion versus what was expected to be $155.04 billion. Amazon Web Services came in at $29.3 billion, slightly lower than expectations of $29.42 billion. And advertising was better than expected, $13.92 billion versus an expected $13.74 billion. So Q2 operating income is, in terms of guidance, is expected to be lower than what was forecasted, right? While sales were still expected to be somewhat aligned with forecasts, this is very telling of the story that we find a company like Amazon in. Margins are affected, sales maybe not so much. And this is exactly what it is, right? This is because of the tariffs affecting profitability, and obviously Amazon, by nature of the business, has a lot of exposure to it. However, what is worth considering on Amazon's end is that it is still the largest marketplace. And I don't just mean this for buyers or for consumers. It is the largest marketplace for many sellers. It is one of the best options for many sellers to go on to sell their products globally. And Amazon's ability to offer products at such a low price may actually provide an edge during times of inflation uncertainty, as people will flock to things of value. They will flock to deals, right? And Amazon business always said, your margin is my opportunity. And I think that's going to be very, very interesting. It's going to be very interesting to see how Amazon navigate this, right? Because I think they can leverage their size, their sheer size and economies of scale to not lose as much as some of the other companies may lose. So they don't have to win per se, they just have to lose less than many of their competitors. And I think they are in a position to do that, especially if there is macroeconomic uncertainty. One of the worrying things, I say worrying, but it's not really worrying, but AWS did show signs of slowing down, right? 3 straight quarters of revenue misses, and a big part of this could be because of increased competition, right? Azure gaining traction, AWS losing more. A lot of companies coming in the cloud space, I think Oracle are also growing in it, and increased competition could just be a big factor of this slowdown, but it's still growing at 17% a quarter. It's just not hit revenue estimates for the last 3 quarters. Advertising did great for the quarter. It was up 19% year over year, which was faster than growth in Amazon's core retail business. Now, of course, we've heard a lot from other companies, about a potential slowdown in ad spend. Meta said it, Google said it, I think Snap said it. Amazon would be no exception to this theme, but their economies of scale, as I mentioned, may actually position them better with a lot of sellers who depend on their platform. And simply because of their size, they may be able to eat up some of the pass-through costs to stay in demand with consumers and to stay attractive to consumers as markets become tougher to navigate for companies, for consumers, and for investors. Another yellow flag, I would say, not a red flag, but a yellow flag, is Bezos selling up to 25 million shares Now, this is not 25 million worth of shares, it's 25 million shares. So this is about $4.8 billion worth. This may be a slight indication that he is a little worried about, tariff implications. But again, it's hard to read into this too much. It could just be him getting liquidity for something or the other in his life, or, for some other ventures that he wants to make bets on. But it is worth just considering the fact that he is selling this up to this many shares. So it's something to note amidst all this global uncertainty that, I always thought Amazon was going to navigate this exceptionally well. And I always thought Temu's loss, or these Chinese e-commerce companies' loss, would be Amazon's gain. But the reliance that a lot of American companies actually have on China is huge, and I think we're truly understanding that symbiotic relationship as we dive more into this macroeconomic and geopolitical navigation period, or this entire period where we're just trying to figure out how to not completely stall globalization. But I would say overall, that kind of wraps up the earnings aspect, but I would say overall the theme of this week was really that perhaps it's not doomsday after all, right? Maybe we're not in a place where we have to frantically worry. We saw the macro data come out stronger than many would have thought. Tariff uncertainty remains, yes, but trade deals are likely to come to fruition. And yes, there's probably going to be inflation, but I think once all that uncertainty dies down, equity markets will stabilize, and perhaps in the next earnings cycle, we will see businesses talk with a lot more certainty, a lot more conviction over what the future holds. Now, whether that's good or bad, I cannot tell you. I just think there will be a lot more certainty. Now, on that note, I would like to remind everyone that, none of what I say is to be taken as formal investment advice. Everything is purely for informational and educational purposes. And with that, I thank you for listening. I'm Anurag Birla, and this is the Finance Now Podcast.